steps of how to use these day trading strategy videos. The components in this strategy, which we call the stochastic strategy, is using stochastic, of course, support resistance, and then candlesticks. The first would be stochastic. You know how it measures overbought and oversold. But if you haven't watched our stochastic video yet, which is also free, I urge you to do so you know what this indicator tells you before we start trading it with this day trading strategy. But stochastic shows overbought and oversold based on a mathematical formula. But it can stay overbought and it can stay oversold. So it's very important to use it in conjunction with other things, and that's what we're doing in this strategy. Here you can see I pointed out some places where we are reaching oversold and overbought, and we move down or up from that level. The next thing is support resistance, and this is very important that you use it in conjunction with other things, because stochastic in itself is not powerful enough to make you money. So we look at support resistance in this day trading strategy as well. Here you can see some support areas. It works the same way with resistance, but these are support areas. You can see how we're bouncing on a certain price level. These are horizontal price levels. Support and resistance could also come in the form of an MA, which is dynamic support, or could come in as a trend line. But in this case, in this strategy, we're looking at horizontal support only, because we believe they are a bit more valid and stronger support than dynamic support or trendline support. But as I said, it works the same way with resistance. I'm just showing you an example of how support works. The last thing this strategy uses is what's called candlesticks. It basically tells the same as a bar chart, but it tells a little bit easier way. It informs about the shooting star and the hammer in a more visual way. And day trading is very visual. You have to be able to see these things at the right time and with a lot of other information. So whatever helps you makes it easier to spot these setups. You should use those things. And that's what we're doing. And therefore we have changed our charts into candlestick charts using this strategy. If you don't know what a hammer or shooting star is, let me quickly explain that. Here you see the hammer. We open here. What happens then is that we move down doing this bar, and then the buyers come in and push the price up again, and then we close positive, and that's why it's a green hammer. You can see here's the high. It's not that important. The most important thing is that we open here, move down, then the buyers come in and push it up, and we actually close higher than we opened. That's an intrabar reversal. What has happened at that time is that we have done more than a 100% reversal of the down move. That's very powerful reversal signal. The opposite goes for the shooting star. We open here, buyers push it up, but then the sellers come in and push it all the way down, and we actually close below the opening, and therefore the shooting star is a red shooting star. So this shows again a reversal intrabar. The sellers are coming in, pushing it down. But it's very important that the hammer occurs after a downtrend. So the market has been selling off, or the stock or the future or the forex has been selling off a little bit, and then we get this hammer that forms an intrabar reversal. The shooting star is very important. It occurs after an uptrend. It's kind of a flush out that we have been rallying, and then this is the last push, and the buyers couldn't hold it up there anymore, and the sellers come in and push it down intrabar and make that reversal. So that's very important that these occurs. The hammer occurs after a downtrend, and the shooting star occurs after an uptrend. This is the last component we use to incorporate this day trading strategy. But first let me show you in listed form here the entries and exits. The first would be we need an oversold stochastic, at support, and then we need a hammer to occur. That's for the long signal. The short signal is overbought stochastic at resistance with a shooting star. The exit would then be, for the long, an overbought stochastic crossover of the %K and %D. And again, if you do not know what this is, I recommend that you watch our free video on stochastic so you know what %K and %D is. And then the stop is below the hammer. For the short signal, your exit is oversold stochastic, crossover of %K and %D, and your initial stop is above the shooting star. So now you know a little bit of the background of this strategy and you know the theory behind it. Let's show you some examples. Here you see into. First, we look for the support area. I know that price have gone through this support, but that doesn't mean the support is still not valid, especially when we get our oversold stochastic happening at support. We're getting our hammer, and we have a gap fill as extra evidence. A little bit of extra evidence that makes it a higher odds setup because we just add a little bit to it. Then your stop is below the hammer, and then your exit will be here when the %K and %D crosses each other. Here's another example, Netflix. Again, first thing we look at is support resistance. You draw these lines in. Do not just look at stochastic because then you will be looking too much at the chart. You look every time stochastic is oversold, but it's not at the right place. It's very important the right market conditions are there for your trading. Then we look at the oversold stochastic. We look for a hammer, and then the stop below the hammer, and the exit when the %K and %D crosses. Of course, these are two successful trades, and it's not like that in real life. But these are for examples so you know what to look for and how to enter. But again, combine it with other things. For example, here, the basic strategy has an edge, but you can increase that edge by going with the trend. So, for example, have we been rallying for a while and then we come and bounce on support levels? That's bouncing on support in an uptrend. That will increase the odds of success. You can increase it even more by going with the first setup as well, meaning this is the first time it bounces off the confirmed support. We know that support will not last forever. Sooner or later it will break that support. So if you take the first bounce off that confirmed support, you're increasing your odds of success. These are just some examples of how you can increase the edge. You should work with your own ideas and strategies to see how you can increase your trading edge. Now, as I mentioned, it's very important that you have the right market conditions in order to become successful. One of them could be clean price charts. Look for something where there's not many spikes or gaps or stuff like that, something that deteriorates the charts. Second, don't trade around holidays like Christmas where the volume is low. Third could be don't trade around Fed announcement or other major news. News that can push the price of whatever you're trading, the stock, the future, the forex, in such a big way that you'll either get stopped out or the setup will not come or something like that. These major news move the price too much, so don't trade around that. And again, so on. Figure out what the right market conditions are for you. These are very important. It's not this day trading strategy itself only. No, we actually believe that the right market conditions is more important than the system itself. This ends this video. Please remember to subscribe to the channel so you don't miss out on future videos. Furthermore, if you have any questions or comments, please leave them below. And if you want to, then please rate our video. Thank you.